if Bitcoin succeeds, it'll turn into a barbarous relic like gold, where it's a better currency than paper. That's its success story if it becomes a better currency than paper.
Hi, and welcome to Wealthion. I'm James Conner, and today my guest is Bill Smead of Smead Capital Management, which is a money management firm based in Phoenix, Arizona. Bill, thank you very much for joining us today. How are things in Phoenix?
It's a beautiful day. It's going to be a beautiful week, and I really appreciate you having us.
I'm sure the weather is always beautiful there. I have yet to visit Arizona, but I would love to go. And it's in an interesting part of the country. It's not too far away from Los Angeles, not too far from Las Vegas. And if you're into skiing, I guess you could also drive to Salt Lake City.
Yeah, they even have some skiing in the north part of the state. We happen to have an unusually wet winter this year, and that made skiing better locally, and it made pollen worse now that the weather's getting warm.
And I'm not sure if you're a hockey fan, but one of the greatest hockey players in the league right now, if not the greatest, Austin Matthews, is from Scottsdale.
Yeah, that's amazing because ice doesn't last long here.
Yeah, he is currently leading the league in goals. I believe it's at 69, and there's still a week to go in the regular season. So he's going to be setting records. So, Bill, I want to move on now. And you are a value investor. And just for the benefit of viewers who might not be familiar with this approach, maybe you can just expand on it and tell us exactly what is value investing.
Yeah, value comes in multiple forms, but the main premise, a bird in the hand is worth two in the bush. So we want to buy a bird in the hand that is worth dramatically more in reality than what the marketplace at a temporary point in time is willing to pay for it. So that can come from being a company that's going to grow quite a bit and trades at a very low PE ratio in relation to how much it's going to grow in the future. It can come from being a bargain on their asset base and with a future brighter than what was expected for their asset base. It can come in a wide variety of ways. Sometimes it's the sum of the parts that get us interested, like in the case of a company like U-Haul, which not only rents vehicles so people can move around the country, but also does storage units, which a company by the name of Public Storage proved over the last 40 years is one of the best businesses on the planet.
And so you and I have been involved in capital markets for many years now. And one of the trends that we've seen here in the last 10 or 15 years is this movement toward passive investing, right? And you're an active money manager. And I'm just wondering what your views on passive investing, and do you think active management is a dying art?
Well, it's very much an unpopular art because most of the people that are doing it have not done a good job in relation to what the passive indexes have produced. But the nature of the common stock market is that a good idea ends up getting overcooked. And what's happened now is so much of the participation is via passive indexes that too much of the common stocks in total are owned passively, which dooms any good investment discipline. So John Bogle had a brilliant idea. He said, hey, just get into a vehicle that costs less, that will keep you in the market. You'll have some duds, but your winners will more than offset that. You'll keep your turnover down, et cetera. And that was it was a genius stroke, really. But any good discipline ends up getting overcooked. And just so growth stock investing got overcooked in 2000. And then when that broke, the index did poorly for 10 years. Well, we think in this particular case that the goose has gotten so massively overcooked that the S&P 500 index people have now been jacking reality around by moving tech companies out of the tech category to make it look like a more diversified portfolio than it really is. Because right now it's about 45% in tech, or what most of us would be considered tech companies.
Oh, that's an interesting point. When was the last time it was that high?
Well, the last time it was that high was tech was 30% at the top in the dot-com bubble. Tech is now 30% again in the S&P, but they've moved Facebook and Google and Amazon, Netflix, and Tesla out of the tech category. So in effect, there's another 15 plus percent outside of what is they call tech in tech, which means it's just a glorified growth stock portfolio right now. The S&P 500 is a growth stock portfolio that would fall into the growth stock category, say on a Morningstar analysis.
So before we do a deeper dive on the stock market and determine where you are investing your clients' money, why don't we look at the economy and take a top-down approach? And when I look at the economy and things overall, it looks very good to me. Okay, it's growing at 3 to 4% annualized. This jobless number continues to stay below 4%, and the stock market's making new highs every day. What's your take on the economy?
Boy, that's a great question. To answer that question, I would take your viewers and listeners to the November 1999 Fortune magazine article by Carol Loomis, who is the editor of Warren Buffett's annual letter. And what she did was she recounted the talk that Buffett did in 99 to the dot-com billionaires. And what he explained was from 1964 to 1981, the United States economy grew 4.3% per year. And the primary index in those days was the Dow Jones Industrial Average. And Buffett said the Dow Jones Industrial Average did not break above 1,000 during that entire 17-year stretch, even though at the beginning of that stretch, it was close to 1,000. So the moral of his story was, why did 4.3% economic growth not equate to good stock market performance? And of course, the answer to that question is that interest rates rose that entire time, and inflation was a big problem. And in that time period, I just finished reading Cornelius Bond's book about T. Rowe Price. And T. Rowe Price was one of the great growth stock investors of all time. And in the midst of the 68 escalation of the Vietnam War, 500,000 American troops halfway around the world, and the borrowed money by the federal government to fund that process, combined with Johnson's Great Society legislation, troubled T. Rowe Price greatly. And what he did was he pivoted. He put oil and gas stocks in his growth fund, and he started what today is called the T. Rowe Price New Era Fund, because he thought it was going to usher in an era of inflation. So he owned oil and gas stocks and gold stocks, et cetera, in the T. Rowe Price New Era Fund, which was a massive pivot for a growth stock guy to make that pivot. Was a massive pivot. Well, fast forward to today, that is in effect what we have. The pandemic war is the Vietnam War. And here we are in Arizona. President Biden just tossed another $10 billion to two semiconductor companies to do chips in the Phoenix area. They're throwing out billions just like candy to a baby. Billions of dollars of debt forgiveness for college students, billions and billions. So the point is, the economy is likely to be solid the next 15 years because 180 million out of 330 million people in the United States are under 40. People under 40 are way slower getting their lives started than we used to be, right? We used to get our lives going at age 23 or 24. Now they get them going at 30. And because they're so much slower, we have a lot of household formation and marriages and babies in front of us. But that is inflationary. Necessities are expensive and necessities go up in price, especially when 180 million people want them. And that's where we're at now. So we think we're in an era like the 60s and 70s where the economy is going to be above average. But what happens is, and I've been trying to explain this to people for 43 years that I've been in the investment business. When the economy stinks and the Fed is friendly, when the Fed creates money, it sloshes into the stock and bond markets. So stocks do well when the economy does poorly. Then when the economy's doing well and the Fed tightens up, people take money out of common stocks to do Main Street business, to buy a building for their company, to expand their chip plant, yada yada. Right? So in effect, stronger economic activity is bad for the stock market. And the funny thing of it is, the normalization of interest rates and that fact has not completely hit home yet. And we highly expect it will hit home in the next 2 or 3 years.
Okay, so there's a lot to unpack there. You just touched on interest rates. And when we started this year, everybody was looking for 6 cuts, which was kind of outrageous. But as we've gone into 2024, the economy appears to be stronger than it is, and inflation is also very strong. So therefore, now we're looking at, according to the dot plot, 3 cuts sometime this year. What are your views on interest rates in 2024? And do you think we're going to see a cut? And if so, when might that be?
You just remind me of a Rod Stewart song. Isn't the first cut is the deepest? Baby, the first cut is the deepest. Well, we're having a hard time finding that first cut, and we might not get that first cut. So here's what's funny. If you would have been interviewing me 5 years ago, the thing that we were most frustrated by was we had been telling people that interest rates will normalize at some point. So we've now normalized interest rates, and the stock market has not readjusted its pricing relative to that normalization. The stock market is still priced at a 1 to 2% treasury rate, and we got 5 or 5.5 or whatever it is, right? 5.25. So the bizarre. So people ask me, well, Bill, when is the market going to readjust itself to these interest rates? I say, well, 5 years ago, I would tell people interest rates are going to normalize. And they'd say, well, when's that going to happen, Bill? And then I'd say, well, you can't hold your breath till then. So then now I say that at some point, the stock market is going to rationalize itself against these interest rates. And they say, Bill, when's that going to happen? I say, well, you can't hold your breath till then. we kind of think that we're in 1972 right now. So what happened back in 69 at the beginning of the year, Buffett closed his partnership, sent the cash out to the investors, criticized the stock market, made fun of the go-go 60s. And then we have the 69-70 bear market of 40%. And then they put the bull market back together on a narrow group of stocks, 24 stocks that were in both the Kidder Peabody and the Morgan Guarantee Nifty 50 list. And we had a bull market in 71, 72 on the back of that narrow group of stocks. Now, having a bull market on the back of a narrow group of stocks, does that sound familiar at all to your viewers and listeners? And the answer is, yeah, we went from FANGs to Magnificent Seven to what's the latest group of narrow stocks that are leading this. And that's what 71, 72 was like. But the problem is 72 ended up being followed by 73, 74, and a nightmare market from the end of 72 to the bottom in 1982. And we believe we're headed for there.
Okay, so let me ask you about a few things. First of all, let's just get right into inflation. You're making comparisons to what the inflation we're seeing right now, what's happening, and what happened in the 1970s. And we just recently had a CPI number which came in stronger than expected. And a big part of that had to do with services. Car insurance, for example, was up 22% year over year, the biggest move we've seen in that since 1976. And there's so many other things like, I know I'm in Toronto, but I would imagine, the inflation rates here are probably just as high as they are in Phoenix. But even simple things like going to a barber now, you charge me so much money, I just started cutting my hair on my own, right? But yeah, it's like you can't escape this inflation. It's just nonstop. And even though the government is saying it's only 3%, I think it's much higher than that. But what are your thoughts in inflation? And it sounds like if you compare it to the 1970s, you think it's going to escalate or accelerate. What's going to cause that, and where do you think it might be going?
Well, we have two different strategies: our main U.S. value fund and our international value fund. And our international value fund is loaded with Canadian companies because the natural resource industries are going to win the next 10 years, we believe. So we maybe we should move our offices to Canada or something because it's a better place to be, we think, the next 10 years. So too much money in the hands of too many people chasing too few goods. It's not very complex. That here we are, the Fed has tightened credit, but simultaneously that the federal government of the United States is handing out money like drunken sailors on leave. So the answer is that think of the Phoenix metropolitan area. Well, they just announced they're going to pump $10 billion into the local economy. Well, $10 billion for this is the, what is Phoenix? It's the, I don't know. It's maybe the 5th largest metropolitan area in the United States. That's a lot of money just in that one source. And then you go to Applebee's for the grilled chicken salad, and they have such a hard time hiring waiters and waitresses at the going rate that she brings 3 out of the 4 of them the breaded chicken instead of the grilled. We want the grilled. Well, that's because they have a hard time finding staff, and that means you got to pay more to get the staff you want. And that's exactly what you're talking about. By the way, in the United States, gasoline is a much smaller part of the household budgets than it was 15 years ago. Even at dramatically higher prices, it's a way lower part of household budgets. But it's psychologically important in the United States because it's about the only way the average American family measures inflation. Oh, I went to the pump and I'm paying 50 cents more than I was paying 2 months ago. We've got inflation. And so that's what they're going to see. And by the way, they strip out energy and food. It's like, okay, let's take out the 2 things that everybody has to have and tell people that there's no inflation. It's bizarre. It's there, and it's going to stay there because those 180 million people need the necessities. And as their demand for necessities go up, inflation kicks into gear, much like baby boomers in the 1960s and 1970s.
Yes, I know what you're saying about fuel. It's something you see every day, and I kind of enjoy that, right? Because you get an idea of where it is. But when you look at CPI, it's the 3 primary components are shelter, food, and fuel. Every time I go and get my groceries on a weekly basis, it doesn't matter if I go to Costco, Walmart, or Whole Foods, I'm reminded of what's happening with inflation. If I'm spending $500, I know last year it was $400. The year before that, it was $300. So I'm constantly being reminded. If you look at the real estate market, a home that I could have bought in Toronto 4 or 5 years ago for $1 million is now costing me $2 million.
Yeah.
So it's just not fuel. Like you're being bombarded constantly that these higher prices are really coming home to roost.
Yeah, you brought me to one of our theories, since I'll just pick right up on that point you made. The millennials and the ones right behind them, which is Gen Z, they are going to have to do what Southwest Airlines has been asking people to do for years, which is you're free to move about the country. The arbitrage, the land arbitrage that's going to go on the next 10 years in the United States is going to be huge because most people, the companies should recognize, hey, let's put our employees in a place where they can afford to buy a house. Well, 75% of the land mass in the United States is empty. There's lots of places to put people that are nice places to live. They just don't have much population yet. And technology allows them to be wherever they need to be. That's going to be one of the big themes. So we own U-Haul that helps them move someplace else in the country and gives them a place to store their goods that they didn't want to move. And we like that theme. You're now free to move about the country.
So I want to continue on with this theme about inflation and once again go back to what happened in the 1970s. And the 1970s was very unique because we had 2 major oil shocks. First one happened in the early 70s because of the oil embargo. The second one was in the late 70s due to the Iranian Revolution. And so a big part of this inflation that we saw had to do with oil. I think it was up 200 or 300%. And do you foresee that same sort of thing happening now with the oil price and also given the troubles that we're seeing in the Middle East?
In 2017 through 2021, there was an explosion in U.S. investors' investments in ESG-oriented investments. And there was literally a net money pulled out of the oil and gas industry. That's all you need to know. We have massively underinvested in fossil fuels. We're now going to do AI, which is maybe the biggest electricity eater of all time. Electric cars are massive electricity eaters. It takes 60 barrels of oil just to make a Tesla battery. To make a Tesla requires 60 barrels of oil. So the bottom line is electricity prices are going to go through the roof in the next 10 years. And the sins of the prior 10 years will have penance that match it. And that's, you underinvested in fossil fuels. Our strategic oil reserve in the United States is 140 million barrels below where it was when President Biden started selling. And he said he was going to refill it at 70, and he skipped that. We think it's very possible he won't ever see 70 again. We think oil is going to go to 150 to 200 bucks over the next 5 to 10 years. And I'm telling people I might change my name to Jed Clampett.
That's like the Canadian central bank selling all their gold.
Yeah.
So okay, so we both agree there's an issue with inflation. It's not going lower, it's going higher. And yet this whole move that we're seeing in the stock market is predicated on lower interest rates, okay? But there's no way they're going to be able to cut interest rates if inflation takes off again. Do you think that there's a risk that we don't see a cut this year? And in fact, maybe as we go into 2025, interest rates go higher?
Well, first of all, as a man who started a mutual fund the second trading day of 2008, we're not famous for our market timing. So just give you that caveat right up front. I don't necessarily think I'm any better at predicting the next 6 to 12 months than anybody else. Now, at major inflection points, which, by the way, will be the title of our webcast, is basically saying that stock market psychology is only important at extremes, major historical extremes, and we happen to be in one of those right now. So we don't know the timing of things, but we do feel like we have an understanding of when the goose gets overcooked one direction or the other. So you can't hold your breath till these things play out, but I would say that the likelihood now is this hope that they will steepen the yield curve over the next year. And that is a reason to be as excited about growth stocks as you were before the interest rates went up is in a lot of trouble.
So I understand you don't want to put a time on it, and because you don't want me coming back in 6 months and attacking you because your timing was wrong. But what's the catalyst, okay? If you think this market is so overdone right now, what will be the catalyst to take it lower?
Well, there's a great book by John Kenneth Galbraith, last redone in 1990. And if your watchers and listeners read it, it's a 125-page paperback that only takes about 3 hours to read. A Short History of Financial Euphoria is the name of the book. And he does as good a job as anybody's ever done of explaining financial euphoria using the two historical examples that he focused on was the tulip mania of 1636 and the South Seas bubble of 1720. Well, the beauty of it is in both cases, one country, the Netherlands, and the other country, England, got on top of the world because they had the greatest navy in the world and dominated trade in the world and got incredibly prosperous. So in reaction to getting incredibly prosperous, in Amsterdam, they started trading these fine tulip bulbs, and people got out of control. And at the height of the tulip mania, you could trade a fine bulb for a house, a carriage, and 2 fine horses. And in today's American dollars, that'd be about $700,000 or $800,000 for a fine tulip bulb. That if you plant it, it grows into a tulip. That's how much utility it had. Okay, it's kind of like cryptocurrency or something. Or as Buffett would mention on gold, it's not a productive asset, right? There's nothing produced. So other than just being a payment system, that's all you can have. So he used that example. And then it's in the South Seas bubble, England got very prosperous. And by the way, both cases, the governments of those two countries were just monetizing debt like drunken sailors on leave. John Law looked and he said, wow, there's so much money floating around. How do I get my share of it? He said, oh, I know. Let's anticipate the commercials from the brick trade and go down and start companies, shell companies to go down and bring back natural resources from remarkable Indonesia, which is what the ads were. And so he did that. And of course, even the wisest man in all of the world at that time, Sir Isaac Newton, got sucked into that bubble and lost his entire fortune. If you worked for him and were in his office in the aftermath of that fallout, if you mentioned the South Seas bubble, you'd get fired on the spot. So the beauty of it is, he asked the question, what causes financial euphoria? Is people get enamored with a certain piece of art or an item or a stock market or an industry, and they just get completely enamored with it, and it builds and it builds. It dies of its own weight. You just run out of anybody to participate. And let me tell you, I'm 43 years in the business. I think we know the last 150 years of U.S. stock market history as well as anybody out there. And I can't even fathom if you would have said 15 years ago that we would go 15 straight years where the best performing stocks came out of the prior year's best performing stocks almost every year for 15 years. I mean, that is a complete statistical anomaly, right? I mean, that is a total freak show is what it is. So what we did recently is I got this crack team of analysts around me. I said, guys, let's get me back into RCA. Let's dig back into RCA and compare that circumstance to today. Well, in 1923, 1% of American households had a radio. And in 1937, 75% of American households had a radio, many of them more than one. Well, from 1923, mainly through 2027 through 29, RCA stock went up 11-fold. They were the largest maker of radios. They were one of the two largest national broadcasters and one of the two largest content providers. So they were like Apple, Amazon, and Netflix all tied up into one company, right? So their stock went from 10 to 110 between 27 and 29 to the market top in 29. And then for the next 10 years, it spent most of its time between $5 and $10, even though the adoption of the technology ended up doing everything they could have imagined. 1% household share to 75% household share. Then, right before Midway, when the United States was losing the World War and Canada was losing the World War, you could buy that stock as a single-digit stock. And then from 1941 to 1968, there was not a better stock to own on the planet. RCA was. But you just got crushed if you got caught in the euphoria of those initial years. And that's what NVIDIA is doing. What AI is doing is the same thing the dot-com bubble did. It's the same thing the Nifty 50 did. People overpriced the euphoria. Disney traded at 89 times earnings and 72 at the top. Coke traded at 60. My first stock pitch in 1981 was Coke at 6 times earnings, paying a 5% dividend, a 90% cut in PE ratios, a 90% cut. So Costco at 45 times earnings, when they're so much bigger company than they were earlier, it's like, and a 5%, 5.25% Fed funds at 1%, maybe you could believe that. It's just crazy. And that the penance for those sins are going to come out in the wash the next 3 or 4 years. But we just don't know when it starts. I thought it had started in 22, but 22 was the 69.70 bear market. And now we've done the Nifty 50 bull market. It's not over. Maybe at the end of the year or early next year, it'll be over. And then the bear that follows that one is going to be a whopper. like the 73, 74 was. That was a 50% decline. And at the bottom, so Buffett gave the money back in 69. He got called by Forbes magazine at the bottom in 74. He says, what do you think of the market now? He said, I feel like an oversexed man in a harem.
That's a great quote. I might have to use that. Okay, I want to ask you about Bitcoin. Okay, so are you suggesting Bitcoin is going to go the way of the tulip bulb?
I believe that Bitcoin is going to go the way of gold. So I spoke at an event in Houston about 6 months ago, and the other speaker was Jeremy Siegel. And Jeremy Spiegel updated that wonderful chart that shows that 250 years ago, you started with $1 in paper dollars, $1 in gold, $1 participating in the bond market, and $1 participating in the stock market, how you do over 250 years. And the gold grew, adjusted for inflation, to $1.75, and a paper dollar was a penny. So gold was 175 times better than paper dollars. But you were a rich person from the bond market in that time period, and you were a rich, unbelievably rich person from what happened in the stock market. In other words, if Bitcoin succeeds, it'll turn into a barbarous relic like gold, where it's a better currency than paper. That's its success story if it becomes a better currency than paper. That's the upside. It's an inanimate object. It's got no productive value. It's just like gold. It would become a better currency. And watching people treat it like an investment is bizarre. It's bizarre. They'll say, well, Bitcoin's hard to mine. Well, gold was hard to mine. So I'm kind of in the Munger camp. It's more of a rat poison. I'm a Jamie Dimon, Charlie Munger guy in that subject. But the best case scenario would be an alternative currency.
Interesting viewpoint. So let's bring it back. I want to look at the stock market now, and I want to find out where you and your team are investing. And so you are suggesting that this market that we're in is a massive bubble. It's going to pop. It's going to be ugly. So how are you navigating these markets right now? Where are you investing your capital? You made mention earlier that you're investing in Canadian commodities.
Well, in the international strategy, we're massively overweighted oil and gas. And in the U.S. strategy, we're 25% overweighted in oil and gas, which is also massive relative to our competitors in the value space and our competitors in the active space. And of course, 3.5% of the S&P is in oil and gas, even though it produces 8% of the profits and free cash flow of the S&P 500. So in the 70s, the only real major category that made people a lot of money was oil and gas. So we've got them. We've got some participations in real estate, which have a tendency to benefit from inflation. So American households were massively underbuilt homes. We own the home builders because that's a way for the average household, besides their labor, to defend themselves against inflation as being their own landlord. But as we've already mentioned, they've got to build these houses places different from where the houses have been built currently, so that they can move about the country to take advantage of land arbitrage. And then we own U-Haul. It's another way to take the benefit from this. And then we own the banks that cater to the millennials, American Express, Bank America, JP Morgan, and now 3 regional banks that looked hellaciously cheap to us in November. And banks in general look very cheap historically in relation to the S&P 500. And then we own Merck and Amgen, which trade at a large discount to the S&P 500 price earnings ratio, even though they've been superior companies for decades and have no more risk in them than Apple does, which is they got to bring out a major new product every 3 or 4 years, which is exactly the same risk you take in Apple. But we get that at a 40% discount to Apple's price earnings ratio in Merck and Amgen.
And you mentioned you're investing in regional banks, and I'm surprised to hear that, given you're a value investor. And we've seen a lot of trouble with regional banks here in the past year, Signature, Silicon Valley, more recently, New York Community Bank.
Yeah. By the way, the the area that has been the slowest to adapt to interest rates is venture capital, private equity, private credit, and that was all part of the woogie. And 2022 exposed all those problems. So you see that 69.70 bear mark destroyed the woogie go 60 stuff. This 22 bear market crushed the ARC funds, crushed Peloton, Beyond Meat. We joked, we wrote a piece back 6 years ago called it, or 5 years ago, the Beyond Meat market, right? It crushed the egregious stuff, the meme trades, the SPACs and IPOs. That stuff got crushed in 22. What we haven't crushed is the growth stock mentality. See, Charlie Munger passed away, and he was brilliant, and he convinced Buffett that it was okay to overpay for a company that was going to have 18% return on equity on average for 20 years. But when everybody decides that's a good idea, and that means you pay 45 times earnings for Costco, even Munger would have to admit at some point it's a bad idea. Again, it's just like the S&P gets way overcooked. That becomes a bad idea. That kind of growth stock investing becomes a bad idea. And even T. Rowe Price pivoted away from that, who was the greatest growth stock investor from 1925 to 1968.
So you're a big proponent of value investing, and therefore Warren Buffett in his AGM is coming up in Omaha next month. Have you ever gone?
Oh, I've gone 14 out of the last 15 years.
Oh, wow.
Yeah. So I'm disappointed this year. He has two stock pickers backing him up. And that's who I'd like to hear him and Ted Weschler and Todd Combs talk. Greg Abel does a good job of running the operating businesses, but that's boring. And Ajit Jain is a mathematical wizard and insurance specialist, and that's boring. I don't want to hear about that. I want to hear what these guys think. I want them to expound. And without Charlie there to be the aggressive one, I'm fearful. I'm fearful of how much, because they ask patsy mamby-pamby questions. You know, half the questions are coming from a 10-year-old child in the audience and saying, the blooms are out. How can I make money on a bloom stock? That kind of question. And that, that's not good. And you got the greatest investor of all time. You want somebody to say, well, you closed your partnership in 1969 and sent the money out. How analogous is that to where we've been lately? That's the question you want. And you won't get that anymore. Nobody asks them the questions that really allow them to expound on what's going on. And in his letters, he just kind of gives these so subtle hints, right? But not just coming out. I mean, God willing, I would live to be 94. He just doesn't want to die with enemies, is I think the deal. And I can't blame him for that. It's a nice guy.
Yes, I went once in 2018. It was a great experience. I would highly suggest anyone and everyone to go.
It's incredible. People from all over the world descend and enjoy thinking about how to make money owning common stocks.
Well, that was a great conversation, Bill, and I want to thank you very much for spending time with us today. If anyone would like to learn more about you and your firm, where can they go?
Smeadcap.com, SMEADCAP.com. Just click on our advice. We write regularly. Tomorrow, our quarterly letter comes out in the what we call our missives list. And we do podcasts at A Book with Legs. You can probably see that in the background. And we're just out there all the time, making every effort to communicate the discipline that we practice. And we appreciate you having us on.
Well, it's good. I didn't realize you had a podcast also. I will make sure I download that.
Yeah, it's coal is driving that, and we're just taking great books that from a wide variety of disciplines, just trying to make ourselves better thinkers by doing a lot of reading. And the term "book with legs," of course, is what Charlie Munger's family called Charlie because he always had his face in a book.
Oh, that's interesting. Okay, well, once again, thank you very much. And maybe we'll get together in a couple of months and you can tell us all about the Berkshire AGM.
Great, thanks for having us.
Thank you. Well, I hope you enjoyed that discussion with Bill Smead. I really enjoyed his insights on the history of the financial markets and how you can learn from the past. When we conduct these interviews, we're trying to provide you with insights on how to navigate the financial markets. And if you need assistance in doing that, consider having a discussion with a Wealthion endorsed financial advisor at wealthion.com. There's no obligation to work with any of these advisors. It's a free service that Wealthion offers to all of its viewers. Don't forget to subscribe to our channel, wealthion.com, and also hit that notification button to be kept up to date on upcoming events. Once again, thank you for being with us today, and I look forward to seeing you again soon.